Should you invest a lump sum in this market? I've been getting this question a lot lately from people who, for a variety of reasons, have a big lump sum to invest and are nervous about putting it in the market all at once. So, should they dollar cost average, given that US stocks are at all time highs, valuations are lofty, and there's some perceived policy uncertainty and geopolitical risk out there? Here are four quick points to help. One, yes, US stocks are expensive. Forward PE ratios are around 22 compared to a 30-year average closer to 17. The longer-term Case-Shiller PE ratio is 35 compared to a 30-year average closer to 30. But just remember, current valuations don't tell you much about the market's direction over the next 12 months. If they did, market timing wouldn't be impossible, and we'd have a trigger. We'd know that once valuations hit a certain level, it's time to sell, and that just doesn't exist. And the reality is, over the last 35 years, when you invest at market highs and look 1 year out, you're better off than investing in any other day. Two, the decision whether to dollar cost average or not is basically a market timing call that you're making that the next 6 to 12 months or whatever interval you choose to dollar cost average will be negative instead of positive. You could be right. In my experience, that would make you lucky, not necessarily that you had a good market timing call. Much more often than not, when someone insists on dollar cost averaging versus a lump sum, they would have been better off just investing the lump sum from the get-go. There's also the nightmare scenario where you decide to dollar cost average, and let's use 12 months as an example. Over the next 12 months, and the market does very well, which again, that is the monthly base case. The monthly base case is that stocks go up. And then in the 13th month, the downturn you were worried about happens. Three, if you're investing in a diversified portfolio, remember, not all of your money will and should be going into US stocks, the area of the market that you're probably most concerned about given the all-time highs and the valuations. There should be international stocks, which are cheaper now than the US, bonds, and other asset classes. So yes, the bigger portion will be going to the US, but not all of it will be, and you have to factor that into your investing decision. And then four, a disciplined rebalancing approach can head off some of this concern. If the worst case happens and we get this precipitous market decline right after you invest, and I'm talking, 20 plus downturn, you should view that as a buying opportunity, rebalance from some of your other asset classes that have done well, purchase stocks, and take advantage of that sell-off, which is, providing you, in essence, a way of having dry powder versus reserving some of your money, waiting for a downturn that may never come. What does all this mean for you? Ultimately, the money needs to get invested in the right place long term. And if that means dollar cost averaging is the path that you're going to choose to do it, great. Just know that you have options and there are other things to consider. Thank you for listening. Be sure to check out my blog, thebostonadvisor.com, for more investing insights. And if you like this video, please like it and subscribe to the channel.